Hey everybody, this is PT from the Propsense team, and today I want to spend some time going over just a little bit of the details for the bias. We're going to get into the technical setup a little bit and touch on that. Then we're going to go to how to improve my trading. I'm sure everybody has watched Cam's videos and are really getting the foundation together of how to trade this strategy. And then the last thing, I'm going to spend some time in the Q&A. It's about midnight my time, so if my energy's a little low, I apologize, and let's just hit it and go for it. So what I do want to start with, a bit of a disclaimer. So first and foremost, Propsense is not giving you any form of investment advice here. We're not telling you to do any transactions. We are basically sharing this information to serve you with education and without obligation and without specific recommendation for action. So do your own due diligence, test and verify, and take ownership of your trading decisions. We are not giving out any investment advice, and we are not giving out any kind of trading directives here. Contact your own personal finance advisor before carrying out any specific transactions or advancements are what we recommend. So you can read that down the bottom. Just be aware that is the case. And as I said, we are going through 4 things today. Basically, we'll spend some time on the bias and what it means, the technical setup, execution and improvement cycle, and then your questions answered, the Q&A. And what I want to do is I want to start a little bit with a story, because I heard this one this morning and I thought it was really, really, really relevant with life as a trader. And this story was from Sadhguru. If you know him, he is an Indian guru who is sharing his yogi perspective on life, and really, really great to listen to, open up your mind a little bit. And his story goes a little bit like this. There is a sensei in Japan for karate, and a student comes running up and says, Sensei, I see the way you do your snap kick, and I'm much, much younger than you, and I have so much more energy, but my snap kick is only 10% of what you can do. And I see the way you punch, and my punches are only 10% of what you do. How can it be? What can I do? Why am I not as good as you? The sensei looks at the student. Do you wake up and do you look at the sunrise and do you look at the birds and you see the light bouncing from the bird's feather right at the tips? The student nods his head and says, yes, I do. And what about in the afternoon? Do you see the sun, how it bounces off the mountains and it illuminates the clouds and they look magical? And the student says, yes, I do. I look at this. And what about the moon, when the moon is rising above the lake and you can see the mirror-like reflection off the lake and you see 2 moons? Do you see this? And the student says, yes, I do. I see this. Aha, the sensei says. This is the problem. You're studying shit. You need to get back to work and practice. And I thought that was quite a funny little story, because basically that's it. With trading, so many people, instead of spending the time doing what matters to improve their approach, they spend time on YouTube, on podcasts, on listening to ebooks, audiobooks, and basically in the wrong areas to improve their trading. Whereas working on your execution, knowing your approach better than anybody else, making it your own, and improving your execution on a daily and weekly basis is how you get better at trading, right? A combination of knowing the approach better than anybody, not knowing other people's approaches, you got to make it your own, and knowing how to improve your approach by introspection and review is how you get better at this game. So that story I thought was really good. And what I want to do is I want to start on step A, as I said, is the bias. So let's have a look and see a little bit about it. So the bias is everything. It's the key. It is the most important factor for us in our trading approach to get right to enable success in trading. The bias tells us which direction we should expect the next move, and then we use our technical approach to capitalize on that move. In a nutshell, the bias is formed by watching the most relevant stock markets or stock indices to see if money is flowing in or out of risky asset classes. Right? This is known as risk on or risk off. You've heard it if you watch CNBC or any kind of financial YouTube videos. They'll talk often about risk on, risk off environments. And we are trying to work out if we are trading in a risk on and risk off environment. We are effectively a bias trader or a correlation trader. And what we're trying to do is we are trying to work out, is money flowing into or out of the trading vehicles we are wishing to trade? So in the following pages, we will use Australian dollar US dollar pair as our pair to explain the bias and the factors impacting the bias. So very, very funny. Lots and lots of people in trading currency pairs don't actually think about what they do when they buy a currency pair, AUD, USD in this example. Now, on the left-hand side, or the first three letters, AUD, is known as the base currency. When you buy the pair, you are acquiring inventory of the base currency. The last three letters is the quote currency. This is effectively the currency that you are using to buy the base currency. So in the case of AUD USD, let's say I want $1 of AUD in my inventory or my wallet. I then go to the currency exchange and I get my 0.6344 US cents, not that you can do a fraction, and I will then exchange that for $1 Australian dollar. And that is effectively what is happening when you buy AUD USD. You are selling US dollar and you are acquiring Australian dollar, right? So when a trader buys AUD USD, it means they are simultaneously buying AUD and selling US dollar. When we break this down, it actually means we're expecting the Australian currency to appreciate against the US currency, right? This is if we are a speculator and if we are a trader, this is what we want. If you are going on holidays, you probably want to experience the Australian beaches and buy an Australian beer if that's your kind of thing. So you want the Australian dollars for that and you get rid of your US dollars at the currency exchange to do this. Now, this could be read, if we're a speculator again, that we expect the Australian economy to grow in comparison to the US economy, right? Not an overall size, but just the growth rate, for example. Another instance would be that we wish to invest in an Australian business and we would exchange US dollar for Australian dollar to do so. Therefore, we buy AUD US dollar. And I'm going to give two examples of that. So let's say you are a hedge fund in the US and you are wanting to buy an Australian business. You're on the Australian stock market and you are looking to put money into BlueScope Steel. You would then need Australian dollars to then invest in the Australian stock BlueScope Steel. So you'd get your US dollar, you would transfer to Australian dollar. So you'd buy AUD USD. Then you have inventory of Australian dollar, which you would invest in the Australian stock market BlueScope Steel. Right? That is an example of a hedge fund in a risk-on scenario looking to put money into the Australian stock market. They have to buy Australian dollars, which is helping AUD USD rise. The second example I'd like to give is, let's say your business is Rio Tinto. You are looking to expand your mine in Australia. You bring your money from another currency, in this case, US dollar. You would transfer it to Australian dollars to fund your expansion because you need to pay contractors, civil works, you've got machinery to buy, so on and so forth to expand your mine. And to do that, to transact with Australian businesses, you need Australian dollars. And this is another example of money flowing into AUD USD. Okay, so how the bias works, to give you this kind of breakdown that I just talked about, for AUD USD to move up, and we've got it moving up on the left-hand side quite in a nice way, we would need a risk-on environment. So an example, during the Asian session, we're looking for the largest indices, China A50, Nikkei, ASX, to be moving up. This is showing price is flowing into riskier assets, and participants will acquire AUD by purchasing AUD USD. Next, we would expect commodities to be going up. And the reason why, or want it to support our case, is because the Australian economy is very mining driven. If you look in Western Australia, huge deposits of iron ore. If you look at Queensland or Northern New South Wales, you've got coal. In the middle of the country, you've got gold, copper, zinc, lead, for example, near Mount Isa. So ultimately, you have a large mining economy. And in the scenario where commodities are rising, you will have money flowing into Australian investments to capitalize on the growth. So a quick example of that is, let's say the iron ore price is going up very, very high. This means demand for iron ore is growing. So people are taking the inventory. There is less inventory available. Therefore, the prices are going up of iron ore because it's a rarer commodity. And the more people bid for something in a demand environment, the more the price goes up. Then you have Rio Tinto saying, cool, no problem. I need to create more supply. I'm going to open up a mine that I had mothballed or frozen. I'm going to reopen my mine and get that running again. I need to put money into the country. I need to invest in my mine to get that running. Therefore, you have a scenario where Rio Tinto is trying to make more money from the available demand by increasing the amount of supply, by investing in their Australian operation. So this is giving you an idea of what exactly is happening when you have the commodities going up and how people expect it to impact the AUD as a whole. The last part is the quote currency, which is the US dollar. So again, we are looking for this to weaken if AUD USD pair is going up. A weakening US economy will actually push the AUD USD pair up. We can also view how Euro USD is behaving. So again, if you look at the base and the quote currency is the same as AUD USD. So the behavior should be similar. If US dollar is weakening, Euro USD should move up. If US dollar is weakening, AUD USD should move up. So again, we're looking at the correlations to work out, is it being respected and is the same behaviors happening on like quote currency basis. Or the other side is Swiss franc, US dollar Swiss franc, where you have the base currency US dollar and the quote currency Swiss franc effectively should be moving down, which again is representing US dollar weakening. So for AUD USD to move up, risk on environment, commodities rising, US dollar weakening, and this guy is going to go upwards relatively fast. Now, I made this for the PDF documents. If you haven't looked at the PDF document, direction and environment, please get into it because this is really going into more details here. But basically, there's a quick cheat sheet. I've kind of cleaned it up a little bit. But let's have a look very quickly at the Australian dollar right here. So Australian dollar, as we just described, if we want Australian dollar to rise, what do we want? We want a risk on environment, especially for the indices which really, really impact AUD USD. So China A50, Nikkei, and the ASX, would like them to be rising. And effectively, this is giving a risk on environment. we want to see commodities rising. So gold or iron ore or copper, we would like to see rising. And this again is boosting our AUD USD. We should be seeing this appreciate, go up. So that's a very, very quick look at the cheat sheet. And again, I've got this stuck on my monitor. I use it, quick reference. I can't remember everything. But what you do is you can work out that everything pretty much is fairly much the same. If money is flowing into the indices or into commodities, you have AUD USD moving up. If money is flowing out of the indices or the commodities, you have it moving down, for example. Now, with the bias, your job is to work out, is the bias being reflected in the charts? Because you can have a scenario where, let's say, the commodities are rising, but AUD USD is not rising. So what's going on there? Your job is to look through the indices, to look at gold, and to understand what could be impacting the pair you're trading. Okay, so let's just show a very, very quick example of a risk-on environment. Here you have a China A50 index. This is a 50 largest stocks, A-grade stocks in China. You've got the Nikkei 225, and you've got the ASX 200. So these are primarily the largest indexes in Asia. From left to right in size, so China A50 is the largest by far, representing the largest economy. Japan is the second largest economy in Asia, and then ASX is or the Australian economy is much smaller than the other two. And what you've got here is, if we look at far right-hand side, is we've got price moving up. When I'm looking at this, let me just get some kind of drawing tool. If price is kind of stuck in a range, I'm not saying there's a bias there, right? But when I have price breaking up and we've got clear movement going on like that, then I'm saying, hey, we are in a defined environment. We are really, really showing that price is moving up and money is flowing into the stock market. Therefore, we are showing a risk on behavior, right? So what do I need from this is I need to go, cool. I don't take it at face value. I then go to AUD USD. Let's say I'm trading that. And I look at the most recent price action. Is AUD USD moving up in a similar way? Right? You would take note of certain things like this. Did AUD USD pull back at the same time or a similar time? Did it pause? Did it break out of the highs at a similar time? Right? So you are asking yourself, is the bias being respected? And is the bias really, really strong? If the answer to those questions is yes, then you have a tradable scenario. Okay, let's have a look a little bit of commodities and commodity impact. So what I've got here is I've got the Australian dollar, US dollar in the middle. I've got US dollar CAD on the right-hand side and crude oil on the left. And let's have a look. So the time, you'll see the times are the same. All of them are ending at 7 o'clock, 7 p.m. And we've got this kind of first line at 12 midday. And what you can see is from 12 to around 2 in the afternoon. Oh, I'm using the wrong tool. One sec. You have oil moving up. So what do we have on AUD USD? It's moving up. And what do you have on USD CAD? Moving down. Very interesting. So again, you can see the base currency and the quote currency is swapped. AUD is appreciating in this scenario. CAD, US dollar is depreciating. CAD is strengthening, right? The next 2 hours, you have oil dropping. Next 2 hours, you have AUD USD dropping. But the inverse relationship, next 2 hours, you have US dollar CAD rising. Again, because the base and the quote currency is swapped. This is representing US dollars more than anything. Then from 4 o'clock to 6 o'clock, you have oil rising. 4 o'clock to 6 o'clock, you have AUD USD rising. And US dollar CAD falling. Then the last part of the move, you have oil falling. Right? Last 1 or 2 hours, you have AUD USD falling. And you have US dollar CAD rising. And this is a very, very good example of the commodities impact. And again, you have to work it out. Sometimes the moves are priced in, which means they are not reflected by the currency pair. It is not being observed. The correlation is not strong. Other times, this correlation is very, very strong. So you should be looking at, are my behaviors matching, right? You can draw on a chart like this and you can say, okay, I can see it. So that's a very, very quick example of the oil impacting AU and UCAD. Let's move forwards. The next area we like to look at is the correlation between the different pairs. And as you know from Cam's charts before and videos, is he sets his monitor up in a certain way. We look at 6 pairs. We have the quote currency US dollar on the top and the base currency US dollar on the bottom, right? AUD USD, P USD, Euro USD, US dollar CAD, US dollar Japanese yen, US dollar Swissy. And what we're trying to do is we're trying to see, are the correlations being respected? Is it looking like it's all the same? So again, this is just a scenario to show it. It's never going to be completely perfect like this, but you know, we just wanted to set it up in a way that you can see what a perfect clean environment would look like. And the example, you would have Euro USD moving up last hour, Japanese yen moving down, Swiss franc moving down. You've got GU moving up, maybe a bit sideways, AU moving up, and UCAD moving down. And that's showing again exactly what's going on. And again, this isn't always going to be like this. I have set this up to show a really, really clean environment. It's not always perfect like that, especially with Japanese yen. It's often doing something completely different, but you can generally see Euro USD and USD Swiss franc acting very, very mirror image like that, and AU and UCAD acting mirror image like that, right? And that's a standard behavior in a clean environment. So for example, you would be saying, I have my bias, I'm in a risk on scenario. Risk on, I would expect AU to go up. Now I'm going to check AU, is it going up? Yes, it is. Good. Now I'm going to check UCAD. Is it going down? Yes, it is. Good. Right? I can start to get the idea that the bias is strong and it's being respected by the currency pairs. That's giving me a tradable, clean environment. Right? Let's show you very quickly an environment which isn't so clean. And we've seen this the last couple of weeks. We've seen this. It's been a little bit all over the place. But here we go. We have EU moving up, and then you've got Swiss franc moving in the same direction. Now that shouldn't happen, right? These are supposed to be inverse. The standard behavior is inverse, and that shouldn't happen. But it has happened in the last 2 weeks. I've seen this on multiple occasions, and it's a warning sign. It's saying, hey, don't trade. This is really, really confused, right? You've got scenarios where you've got EU moving up, but you've got AU moving down. Again, confused. Don't be trading. Again, I've set this up. This isn't a single screenshot. I just wanted to show you what it meant. So when you are going through and you're looking at the current price behaviors, you're starting to think about, okay, what are those price behaviors doing? And does it make sense for the environment that we're in? And again, I'm trying to work out more than anything, is it an area where the biases are being respected, or is the market somehow confused and doing its own thing? If I can't work out what the market's doing, I can't trade it. Right? It's really, really dangerous. So that's the main purpose of us looking at these pair correlations. So once you've got your bias from the IG, effectively you are coming into the currency pairs and you're checking, are they aligned or are they in a bit of a mess? Let's move forwards. So one of the questions I had on the IG was a bit of a checklist on how do I find a bias and what's a process. And I tried to give you some questions that you could ask yourself and the steps. So me personally, even before I'm looking at currency charts, I'm starting and looking at the most relevant indices or commodities to the market time I'm trading. So what I mean by market time is, let's say I'm trading the Asian session. I don't care what the FTSE is doing. FTSE is not relevant to the Australian markets. What I'm caring about is the China A50, the Nikkei, and the ASX. I'm caring also about iron ore, copper, gold to a certain degree, maybe oil. But more so, China A50, Nikkei, and the ASX. If I was trading London, for example, I would be caring first and foremost about the DAX. Then I would look at the FTSE. Then I would look at the CAC, which is the French index. On all of the market times, I'm also getting a judge on the US dollar because we're trading against the US dollar in most places, or we're trading US cross or base currencies. So effectively, I would look at the S&P 500. Some people like to look at the Dow, but I like the S&P 500 because it's more broad across many sectors instead of just 30 stocks. So that's just me. And then you're asking yourself, are the indices or commodities in a strong risk on environment or strong risk off? Now, the reason why I use those words, and you have to work out what it means to you, but strong risk on is super clean. It's super clear. The market, let's say the A50 is rallying like crazy. It cannot reverse. If I'm in a strong risk on environment, I then can easily see if the bias is in play, right? If it is not strong risk on or strong risk off, let's say it's just going up slightly and it's chopping around, this is a really difficult market to trade. You would expect the AUD USD in this scenario to be choppy as well, which makes it a bad environment for us to trade. The second thing, after I understand am I strong risk on or strong risk off, I'm going to the IG market correlation being respected. So this is what I talked about before, is I'm looking at the different currency pairs and I'm going through and seeing, okay, my IG, I'm in a strong risk on environment. Is that reflecting in the charts? So if AU DUSD is being the target for our correlation, and let's say we're strong risk on, which means the China A50 or the Nikkei or the ASX is moving up, I would want to see AUD USD moving up in a similar fashion, right? And that then is, I'm saying, cool, my currency pair, all the currency pairs are responding to the indice or commodity bias. Great. Step C, I would then check my currency pairs. So like we showed before, let's say I'm trading AUD USD, I'm then looking across to Euro USD. I'm looking at the Canadian dollar or Swiss franc, USD Swiss franc, and I'm saying, are they moving in behaviors like we should be seeing? So if AUD USD is in moving up and we're a strong risk on, I should see Euro USD moving up and I should see the Swiss franc US dollar Swiss franc moving down, and I should see US dollar CAD moving down, right? If I'm seeing that, great, I'm in a good trading environment still. And then the last thing I'm doing is I'm not making sure I'm not going to trade in a time that could change the bias drastically. So is there news, or is news coming up, or is there a market about to open, right? This is giving me my picture of the bias. I'm going through this and I'm really, really understanding, are we in this scenario? Cool. Let's move forward to the technical setup. So I would say it like this: bias plus momentum plus breakout equals opportunity, right? So the Propsense core strategy is a combination of directional bias driven by intermarket forces. We're trading a bias. We're effectively a correlation trader. We're taking reference from other markets to know the direction, and we're checking the technical setup for the timing of our entry. This bias is caused by money flowing into or out of a specific base currency. Momentum is the force behind the move. We only wish to trade when price is moving quickly in our favor. The breakout is a technical confirmation that price is moving in a direction we want it to. The breakout point is our execution price. The breakout is formed when price attempts a reversal from the momentum but fails. So to kind of break that down, let's say we're looking at a chart and on the left-hand side, we've got it. Price is moving up crazy fast. Really nice. We then have a pullback. Great. We are not entering here. We're not trying to pick the bottom because you don't know if it might keep going down. We are effectively, now I'm supposed to rub that out. There we go. We're effectively waiting for price to start to prove itself. And how it does that is it breaks out from a previous area where it pulled back. When you're getting this breakout, that's your entry point, and we are expecting it to continue with the same momentum up. Effectively, this is designed as a scalp trade. It's to get you into a winning trade as fast as possible, and your job is to hop off that trade either when momentum slows or you have a valid exit rule in play. Now, I say it that way because the exit and the trading objective is different for each person. A quick example is Cameron will jump into a trade like this and he will see it rocket up and he'll go, great, I'm out. And he will take his money very, very quickly off the table as a scalp. I may have a different objective. I may be trying to compound my account and I might do this. I might take my entry here. I might hold up here. Cameron has exited and then price starts pulling back. I then adjust my stop loss up. So my stop loss is here and I'm now looking for that momentum to continue higher. My objective may be completely different to Cameron's and I will trade it differently. So not one size fits all, but the goal of this setup is to get us in a direction of the bias with momentum, with a breakout as confirmation, to get us into a profitable trade as quick as possible. This gives us some quick examples, right? So we have bias, momentum, and breakout. The trade must be in a direction of the intermarket bias, risk on or risk off, as we talked about previously. The momentum is showing that price is really respecting the bias and it's moving in a strong way. It's clearly responding to that bias. Like, we don't want to see it going sideways forever and then we're guessing an entry because we are effectively not sure. We want to be seeing the price has been respecting the bias. And the last is the breakout. This is really where we get our technical entry. So it's where you have the momentum, you have a pullback, and then you're breaking out this area. We're jumping on and continuing that ride. And you can really see it. You've got price, for example, coming up here. It's then kind of chopped sideways, Then we're getting our break and riding up with it. Prices fallen here. We've got a standard pullback. And then as we're breaking out, we're jumping on board and it falls down. Same here, very, very quickly. We have price moving up. We've got a very quick pullback. I love these trades. Then it moves up, breaks out, and we're riding that up. This gives us a very, very tradable scenario. So again, the bias is where we get our direction. Momentum, we have to see this in the market first. We don't want market to be chopping around or going sideways. And the breakout is really exactly our entry point. So if you watched Cam's videos, and you should have, especially the one which is how to master Forex in 1 day, you will hear about the books. So what are the books? Books are dealing levels which have pushed price effectively. So if you think pragmatically about the Forex markets, we're talking about $1 trillion a day market or billions a day, depending on the currency pair. And effectively what you're talking about is you're talking about having enough volume or liquidity to move price from a point. So it means there is a serious amount of money for price to, for example, move up on this leg. It means that someone is taking all the inventory of the ask side. They're crossing the bid, they're hitting the bid, and they're consuming all that inventory to move price up. That takes a lot to do. And what we're looking at is we're effectively looking at areas of the origin of those moves. And Cam is, we've got one here as well. Cam shows it on his video. If you haven't seen it, please go and watch that video. Forex Mastered in 1 day, I think it's called. And effectively, what we're doing is we're saying, okay, there's institutional traders have been executing orders. Now they're not taking a directional bias. They are executing client orders. They are getting a commission. They're getting paid, and they have a dealing zone that they can deal in. When price moves away from that level, not everything has been filled. Let's say your institutional trader is having a dealing zone of price between here and here. Price gets into his level, he starts his buying algorithm, it starts buying, and he's trying to confuse the market so someone isn't clipping his orders, which means basically dealing to him at worse prices. And he's trying to get the best fills for his clients so he can have the best overall average price. Price goes above here and he stops buying. Other traders move it up, other institutions move it up. Price then starts coming back down. What do we know? We are expecting price to get back into this level, right, in his buying area, because he has more orders to fill. And the whole concept that Cam talks about is no orders will be left unfilled in the market. Basically, the institutions are paid to fill orders for big businesses, for other banks, interbank market, for liquidity providers, so on and so forth. So effectively, their job is to make sure price goes back to these levels so they can fill orders for their clients. So in a lot of different trading theories, when you've got liquidity areas, so on and so forth, often they're used as a price which you could expect to bounce off. Right? We don't do this. We are not expecting price to do that. The only thing we are saying is that price is coming from here, and we believe price is going to there. So it's helping us with our directional bias. We are able to see, if I'm trading from here, how much room do I have for my profits, right? Especially if I put my stop loss there, for example, I can get 1:1.5. Good, that's a nice trade. And we have an area where we think price may respond, but we don't know. It may continue through. So this is how we're using it. We're effectively being aware of these price levels as an area price will reach for, but we don't know if price will react or pass through. And this is giving you a bit of a look and a terminology. So you will have heard Cam talk about rebalancing. So again, this is a balanced book is effectively where you have no orders left to fill. You've filled all your orders and you're able to report to the company that, hey, I've done my commissions and your customer is happy because I've achieved the prices they want. So a book is formed when price breaks through after a move back. So I've made a spelling error there, but black bars only. The first of the open of the first black bar in an up move. So there's the open of the first black bar right here. Let me just grab my pen again. Right here. And that's a book. And when you have a down move, the first black bar, the close is a new book. So prices move down here. This is then showing a book level. Very, very quickly. And if you're not aware, we have an indicator which is automatically painting this for us. This is the Propsense indicator. Hit us up in Telegram and we'll show you where to get it from. But very, very quickly, there are areas where dealing has started and it's pushed price. When price closes past a book, it is said to be rebalanced. Price will then head to the next book in either direction. So, for example, we've had price come down here. One moment. Price come down here. And it has closed into this area. That book is no longer valid. It has rebalanced that book. What do we know? We don't know if it'll go down here yet. It could go back up there. We're not sure. So we will watch what price does. And once it starts moving, we will then see which direction it's going and if we have enough opportunity to make money. Again, as I said previously, we use these to know where price could be heading to. We do not know what price will do when it gets there, right? So it's not like some kind of support resistance or supply and demand zone. Effectively, we're using it to know, okay, price could get here and stall. So if I'm in a trade, I might use that as my exit point, or I might use that to pay very, very close attention to what price does when it gets there. And you can see some really interesting things. So for example, there's this book up the top, and then effectively it's hit that book and rejected from. This book is not balanced, right? Price needs to close in there to suck up all the pending orders at that level, or where that institutional dealing is going to be. We've got a scenario where on the way down here, we have new books forming as it goes down and price pushes away from these levels. We then have price coming to this area it needs to rebalance, and price closes in here, which means that book is rebalanced. It's no longer valid. Now, we don't know, will it continue down? It might reverse and come up. So again, we're not using this to pick direction. We're not using this to try and play a rejection. We're using this to know where price could be going and that we could exit at these areas or watch what happens at these areas. So you've also heard us talk about the fix. And the fix is effectively a mechanism in the Tokyo and London markets where average price is delivered to participants at a specific time. So if you have a huge quantity to deal and you don't want to get slipped on your price and you don't want to have price going everywhere and someone finding out what you're trying to do and moving the price on you, dealing in a fixed times are where you are guaranteed the midpoint exchange rate, right? So fixing is the process of applying a midpoint exchange rate between banks, major bank customers, so like broker dealers, institutional investors, exporters, insurance agencies, etc. 2 times a day, this is executed, once during the Tokyo business hours for the Japanese banks, and once during London business hours. You can expect drastic liquidity at these price levels. Price will often sweep the fix, which means aim to move back to and often reject from the fix. So, and again, we're using it the same way as a book. We're just very, very aware that there's a lot of liquidity at these areas, a lot of people having inventory at those prices. And these are the two times, so 355 for the Tokyo fixed candle and 1759 London fixed candle. And that's on your standard MT4. Those times you can set, but just check with us if you want to check the time frame in the Telegram. So trade process, trying to break it down in an easy way for everybody. Step A, number one, I make sure I'm in line with a bias and have checked my correlations are being respected. So the question I'd ask is, what is my directional bias per pair? Right. Then I would wait for my technical setup to form. No news or market open soon. So I'd be saying, how's the price given a technical entry in the direction of bias? Am I having the pullback? Am I waiting for the breakout to start? Right. The next step, I look at where price could be going. Is there a book or a fix in a direction on my trade? Is the distance to the next book big enough to justify taking my trade? Let's say your stop loss is 5 pips. If the next book is 2 pips away, I don't want to take that trade. It doesn't have enough to go. And the risk is that the trade will reverse when it hits that book. Right? We don't know it. It's not a guarantee, but that would be enough for me to say I don't want to trade it. The next step D is, what are my current conditions and my objective, right? This is how I will set my stops and manage my exit. So if current conditions are volatile, there's a lot of news going on, which is spooking the markets. So you have choppy candles, etc. I might play with a wider stop than normal. Let's say market conditions are not volatile at all and the price moves are very efficient. There's not much wicks anywhere. It's tight ranges, and the trending moves are not showing much pullbacks. They're being bought up every time they pull back, for example. I might have a very, very tight stop. How do you manage your exit and your target? Again, comes back to your objectives. So during a trade, I'm always trying to tighten my stop loss. I'm always trying to reduce risk. Even if price goes against my trade, I will reduce risk because I don't want a full stop. I want to continuously reduce the amount of money I lose. So as time passes, if price goes sideways, I'm tightening my stop. As the trade is unfolding, let's say price moves in my favor, I'm looking at how it moves in my favor. Is it a sudden, really fast impulse? Is it a smooth move that isn't very choppy? If it does pullbacks, how deep of a pullbacks? Do they come all the way back to a previous structure? Or is it only a shallow pullback? This is giving me a judge of momentum, which is then giving me the decision making to say, I either want to get out for a scalp or I want to hold this for longer and make sure I'm defending my risk. So again, that's in a nutshell the trade process. And when you find the bias is super strong and conditions are good, and again, this isn't very choppy, you find these setups just work and work and work and work and work and work and work. And if you took any of these trades on the way up, you would get a profitable trade very, very quickly after entry, right? So let's just talk a little bit about this. Your entry, let's say your entry is here. Let me correct that. Your entry is actually at the line. Your stop loss is here. Within 20 minutes, 4 5-minute candles, you're at 2:1. Perfect trade. Your entry is here. Stop loss, maybe here, maybe a bit less, no problem. Your entry's there on the confirmation. You hardly get any pullback in here. It breaks out, moves up. In 10 minutes, you're at 1:1.5. Perfect trade. You have your next pullback. Your entry is here. 10 minutes later, you could have your stop loss at that level. You're at 2:1. Fantastic trade. Entry is here. Stop loss under these levels. right? Very quickly, 20 minutes, you're at 1:1. Perfect trade. Entry is here. Stop loss down here. You get 1:1 out of that trade. This one, maybe too much of a pullback, but let's see. We took our entry here. You could put your stop loss at the lower structure. Within 20 minutes, you got 1:1. Entry here. Stop loss, 1:2 on the way up. And again, this is why the bias is so strong, because you've got this environment being created because of a bias. And as long as you're trading alongside that bias, you're getting many, many opportunities. Your win rate will be fairly strong. Your risk to rewards can be good. Now, exit, you could be having a different objective. Those examples were a scalp. Maybe you get in here, right? Your stop loss is here, and you hold it, and you hold it, and you hold it, and you hold it, and you exit there. Congratulations, you got 1:8. Right? Doesn't happen every day, but how do you read this? Look at this. Large barge up, no pullback, no pullback, continue up. Small pullback rejected, large bar up. Cool, I can see straight away, every time it tries to move against this bias, it's getting smashed up. Tried to move against this bias, smashed up. Move against this bias, smash up. Move again, smash up. Move again, smash up. Right? This is giving me all the clear confirmations in the chart that I should hold the hell out of this. Right? Maybe you're exiting here when you have 3 black bars in a row. That would be another way. If you have a look at it, you get your entry here, 2 black bars. Nope, 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 nope. 3 black bars. Exit candle is here. You still ride it all the way up. Very nice. That's a legitimate way to exit. Again, you need to work out what your objectives are, and they will change. Some markets are really, really choppy. Some markets you are trading and the environment is not a good environment. So you're saying, I'm just taking a scalps and I'm getting out. Other markets are really, really clean and trendy, and you're saying, hey, I got to hold this thing. I got to hold this thing. I got to hold this thing. Your objectives are different, right? You may be really, really comfortable with a lower win rate and a higher risk to reward. So you're automatically trying to cut your losers and push your winners. That will give you a bigger risk to reward ratio on average when you're looking at your average win and your average loss. Cool. So that gives you a very quick look at when conditions are good. Let's continue moving forward. So how do I improve? This is kind of section D we're into. And let's have a look at performance factors. So at the core of it, trading is a high performance endeavor. You are up against the smartest minds who are building algos, the smartest and sharpest and most prepared traders you've ever come across. They are trying to take money from you. You're trying to take money from them. To truly master trading, you must look at the following factors. Performance issues, right? What is causing you to perform badly? This could even be your computer. Maybe your internet connection's cutting out and your trades are not being executed correctly, or you're getting stopped out because you couldn't exit a winning trade. That's a performance issue, right? Other kinds of performance issue are, I'm no good at getting in after a losing trade. This is foggy, fear of getting in. Or you might have a fear of exiting the trade or a fear of holding the trade. These things can impact your performance. Edge analysis impacts your performance. When you go back and review each trade under the lens of where was my optimal stop and where was my optimal exit. Do that on every trade. Ask those 2 questions. Where is my optimal stop? Where is my optimal exit? And even better, how could I best manage this trade? Once you do that over 100 trades, you're going to start to work out there's a common theme to get good performance with your edge. Execution review. You go back and look at every one of your trades and you say, how did I execute? Is my entry on time, or is it early, or is it late? How did I move my stop loss? How did I exit? Right? You review your own performance versus your plan. Error rate. How many times did you screw up? You bought instead of selling. You put on 10 lots instead of 1 lot. That's an error. Every time you do that, it costs you money. Generally, you don't make money when you make an error. So in a state of 1 week, maybe you do 20 trades, 5 of them errors. Ugh, that's not good. You lost money where you didn't have to. So be aware of your error rate during the week. Adaptability to the environment. Markets change over time. This is why algo traders have a really hard time, because there is a constant adaptation and evolution of the markets changing. It could even be as deep as regulations changing and the way the dealing the brokers have to do, or the liquidity is applied, or the benefits if you are applying liquidity or taking liquidity. Often banks give benefits to the different participants for taking liquidity or providing liquidity, depending on the environment. The benefits could change, which change the environment, for example. So there's lots of factors. The Ukraine war or the Gaza Strip, really, really sad affairs, but these big world news events change the environment. So how can you adapt to it? If you look at the COVID period, you had Swiss franc moving 200-300 pips in a day on an average true range. And then on a standard trading day in 2018 or 17, it probably moved 25 pips for 30 pips. So again, you have to adapt. And how do you trade this? You've got to review on a daily and weekly basis. What is the environment doing? And then the last part is, once you've gone through that review and introspection, you are looking at how you can improve and what are your actions on a daily basis to improve after you've learned all that. We'll spend a little time looking more in detail on these things. Okay, so I want you to pause this video at this point. Oh, well, not right now. I'll wait till I finish, but I want you to pause. This is an exercise. Get a piece of paper in front of you, and I want you to put a line down the middle. On the left-hand side, you put good trader. On the right-hand side, you put bad trader. And what I want you to do with this is I want you to think about all the behaviors and traits and different things a good trader does, and write them down. Make it exhaustive. Write it all down. On the other side of the page, or on a separate page, I want you to do the same for a bad trader. What does a bad trader do? Write it all down. Right? I want you to pause it now and go and do that. Don't continue this video. Pause now. Okay, so you haven't paused. I know you haven't paused. Go and pause it now, please, and do this exercise, because what I want to do is I want you to compare your list to my list. And I want you to see if you could identify all the good and bad trader traits and behaviors that I could. So pause it now, 5 minutes, just write it all down. Good behavior traits and bad behavior traits for traders, right? What does a good trader do? What does a bad trader do? Okay. Good. You can unpause it. You probably have unpaused it and you hear me, but let's go. So I want to have a look at the list, and I'm going to start with the good trader, because we've got to start on the positive side, right? So first and foremost, a good trader trades a validated strategy. This is either through back testing or forward testing, or review of the charts, marking the charts, looking at live markets, getting an idea of the performance of that strategy. A good trader follows the rules 100%. Good traders are not all over the place and breaking their rules all the time. They know the rules is what activates their edge. This is entry rule, exit rule, trade management rule, a position sizing rule, right? They don't take trades outside of this approach. They don't take just random trades. Saw something on Twitter. They saw something on Instagram, so they took a trade. No way. They don't do that. They follow their validated edge. They follow their exit strategy and rules. Well, I said that before, but their exit strategy as well. They want it defined, and they follow it. They never get in a position they can blow up, right? This is over position sizing, trading without a stop loss. They are trading before news where slippage could be crazy. They never get themselves in this area they could blow up. They apply a realistic percentage risk per trade, right? They want to get to as close to 0% risk of ruin. If you don't know what the mathematics is, Google risk of ruin. It's an investment term, and it's looking at your average win and loss, and it's looking at your probability of win, probability of loss, and you're starting to understand what position sizing you should apply. And there's a table, and it will show you where your risk of ruin is with the approach based on the position sizing. And again, you want to be really at a very, very low risk of ruin, if not zero risk of ruin. Not trading during wild events, news, opens, rollover, all this can really, really hammer your performance. It causes slippage, it causes accounts to be blown, gaps, etc. And again, with gaps, you have a scenario where the market is dealing at next available price. And if the next available price is 200 pips away from the previous dealing range, you got gap slipped, your stop loss doesn't exist, and you will get killed. Not trading, not adding to losing trades. Dollar cost averaging and doubling down and trying to average your way out of a trade is when people blow up. What happens is they say, okay, well, I'll buy more. It's going to go up. I'll buy more. And of course, price keeps going down. I'll buy more. And then what happens is it just keeps going down and their account goes to zero. Oops. Or they have a loss so big, it's so hard to recover from. Not increasing stop loss distance during a trade. So a good trader doesn't increase his risk. He only tightens his stop, or she only tightens their stop during a trade. Never trades as a reaction to a losing trade. This is revenge trading. So I just lost. I can't be wrong. I will get back into a trade. Whoops, bad behavior. Or I just lost a trade. I'll take another trade. Doesn't matter. I just need to get the money back. Wrong. Never increases size as a reaction to losing trades. This is called martingale when you do that. Effectively, you are increasing your risk based on performance. You shouldn't do that, right? You've had bad performance. I increase my risk or my position size to recover. Oops, I didn't recover. I've got a bigger hole. You should never vary your position sizing plan for any single trade because you do not know the statistical deliverance of each trade. Win, loss, win, loss, win, 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 loss, loss, loss. You don't know. It does it random, the statistical deliverance of an edge, right? A good trader reviews performance on a weekly basis. Like I talked about just before, goes through all the areas of review, works out how to increase the edge, what errors he's making or she's making, looks at goals, daily and weekly execution goals, to improve that performance and get more out of the edge. Works to identify and reduce mistakes on a daily basis. And a good trader is process driven, not outcome driven, right? That's very, very key. We're not looking at our bank account balance as a scorecard. We're looking at our execution as, did I perform well? Let's have a look at a bad trader. Bad trader enters for any random reason. Market's going up quick, let's go. And then it reverses, kills them. Reacts to sudden market moves without following the rules, right? This is the markets. You're sitting and staring at your chart and suddenly something spikes and you go, oh, I need to buy, I need to get in. And of course, the moment you buy, it reverses. A bad trader risks the farm, the house, the wife, and the family dog in one trade. Oops, I blew up and we now need to sell the house. Sorry. Wants to get rich from one trade. That's you, Mahendra. No, Mahendra sent me a message before. How do I become a billionaire in one trade? That's what he wants to know from his question and answer. And to answer your question, Mahendra, you basically start with $1 trillion, you lose most of it, and you end up with $1 billion. Congratulations. Kidding. Doesn't control their position sizing. I'm just going to put on 20 lots. I'm going to put on 30 lots. Whatever. Doesn't know how much money they're losing when they lose. That's what happens when you don't control your position sizing. They move stops away when price is about to hit. I enter a buy trade. Price comes back to my stop loss. I move my stop away. Oops. I actually took 1.5R, 2R loss instead of 1R loss. Dumb. Trades without a stop. Great. Good recipe for disaster. The unexpected black swans will happen. News will happen. Your price just goes straight past you. You will freeze. You will not hit it. You will not close it. And you will take a bigger loss than you expected. Revenge trades. I had a loser, I get back in. I had another loser, I get back in. I had another loser, I get back in. I had another loser, I get back in. And what happens is you're actually fighting the market. The market is telling you you're wrong, and you continuously keep getting in until you blow your account. That's a revenge trader. Fear of getting into a trade. You have a perfect setup, you don't take it. Oops. Right? Opportunity cost, that is. But fear of getting into a trade also damages the trader performance. Then you're like, I'll take the next one, and the next one's a loser. Oops. Follows tips, Telegram, Instagram setups. Do the work yourself. Don't look at other people. They're not trading your money. You're trading your money. Learn how to operate it. Converts a trade from a scalp to a swing. I got into a buy trade. Oh, I pulled back too far. I moved my stop. Now it's a swing trade. No. When you get in a trade, before you get in a trade, you already know what you're trying to do. You know your objective. You sit there and work it out. A bad trader doesn't cut a losing day short. Too many losses in one day. That's not a good one, right? When you are working out as a good trader, you're having a bad day. You're saying, cool, I've had 3 losses. I'm feeling off. I'm now getting triggered by a market. Time to step away. Bad trader ignores the exit plan. I should exit here. I keep holding. I should exit here. I keep holding. Oh, it's reversed. I keep holding. It's reversed even more. I keep holding. Right? Didn't exit when it should. Could have taken a profit. Ended up taking a loss. Trades during news events. The mentality of this is crazy to me. I want to trade news because it's fast. I'm going to make lots of profits. Yeah, and if you get it wrong, you can lose your whole account. Good job. Never validated their edge. They didn't spend the time. Now, I know the Propsense approach is hard to validate because you need to do it in a live market effectively. Backtesting is a bit more difficult. We'll talk about this a bit later. But overall, you have to do it in a live market. So, how do you do it? You validate your edge. Forward testing. Demo account. Small account. Take the trades. Review. Take the trades. Review. Right? Or you can look back through. You don't have to even take the trades. You just look at, okay, what happened in London session? Right? Get to a sample size which means something to you. 300, 400 trades. You'll do that pretty easily, right? Then you can start to apply capital. So how did you go? Did you get as many as me? I mean, there's more. There's definitely more. But I just want to give that contrast of what a good trader does and what a bad trader does. I mean, you can print this out and you can tick off a list what you're doing, and you can work it out pretty easily. But these are the things that impact your trading. Okay, so the weekly review. This is one of the most important things that I do. And effectively, it's got 3 steps. It's not hard. You can do it once a week. You can do it on the weekend. You can do it on Saturday night. You can do it on Friday night. You can do it on a Sunday. It doesn't matter. But what you do is you finish your trading week and you start by switching off to clear your mind. Get clear. Get away from it. Get the emotions down. Go and play golf. Go to a beach. Go and play with your kids. Whatever you want to do. Just get away for a little bit. Next step is review time. Go back to your charts, paste into a PowerPoint or a document every single trade for the week. Try and identify the IG bias, the intermarket bias during the sessions. Review each trade with the factors in the coming page. We'll talk about it in a moment. And then the last step is improvement plan for the coming week. Have your improvement goals clear for the coming week. Review every day before the trading session begins and repeat the process again following the weekend. Right? This is it. Do it on a weekly basis. Choose the things you're going to work on. Review them every day. Did you achieve it every day? And look how your performance changes. It's an iterative process. This is why you improve over time. Often the errors that you're making today are not the errors tomorrow. You uncover more things as you go along. You correct them and you continue. This gives a quick review factor, and you don't have to do it like this, but this gives you some factors to review. Now, we have our trade up here. We have an entry and we have a stop loss hit. So maybe we look at, did I follow my rules? Did the trade meet all the criteria? The bias, the technical setup, the correlation, the environment, news, or market open, right? And you could rate your safe A, B, C, or D. You could say, I did it well, or I didn't do it well, or you can make some funny chart. I don't give a shit. It doesn't matter, right? But just ask yourself a question. Did I follow the rules? Right? Let's say we did. Cool. We did okay. Entry execution. Let's look at this. Have a look. I can see straight away our entry is supposed to be here. But we entered way down here. Now, either we were slipped, could be, or we missed it. We weren't focused. So entry execution is really poor. Was the entry at the correct price level as defined by a strategy? Did we jump the gun, or did we enter late chase? We chased in this case, right? Next is trade management. During a trade, did we tighten a stop during a trade? Did we add to winners? Did we reduce risk when appropriate, right? How did we manage a trade? Was the stop loss at a good area to start with, or was it too close? Exit execution. How do we exit? Did we exit per the trade environment, right? Did we take a decision on a scalp, or did we hold longer? These are things you've got to think about again. Behaviors. Did we execute as per our goal? Was there good behaviors or bad behaviors? So revenge trades, or fear of getting in, or fear of missing out at play? Or did we over risk? Or did we move our stop in the wrong direction? Again, these are just some factors. You can do it any way. But to improve, you have to be aware and really, really visible of what you did when you trade in different factors. And then you're picking your areas to improve. Let's give some examples, right? And again, you don't have to do it that way. You can do it just like this. Okay, here's a good trade. What have we got here? We got an entry, we got an exit. For me, entry execution was slightly late. I want to enter right here. So we're actually losing a little bit of money. Stop loss was appropriate, right? Our stop loss was here. That's not bad. That's appropriate. Right? Look at this area of this run up. We don't have a lot of chops. We don't have a lot of wicks everywhere. So putting a stop there is okay. Is it also okay here? It's not bad, but you don't have so much of an edge there. You've decreased your risk to reward ratio. The bias was in play. IG confirmed. So we check that and we're all good. Exit was appropriate. This exit's fantastic. We've had 4 or 5 bars in the right direction. We've had a pin bar and it's exited on pullback. That's a great exit. Cool. Overall, this is a good trade. So you'd mark it a good trade. Good job. Let's have a look at another one. What's going on here? We have a buy here. Well, hold up. What do we got? We got a buy here. One moment. We have a buy here. And then we have a sell here. Uh-oh, we got a problem. Right? So trade 1, entry was slightly late. Again, a little bit lower is what we want to see. So let's have a look at trade 1. We want to see that entry a little bit lower. Stop loss distance was too close. Look, we've had this big wick here. Very choppy. Pretty big impulse move. Maybe we wanted to have a less one. We might have got stopped out there. I don't know. But again, maybe the stop could have been a bit better in this scenario. Did we find a bias? Right. When I see this, I'm going, hey, that bias, I would want to check the IG and make sure that looks like the bias is a risk-off scenario, for example. But here's the big problem. You can see it already. We got stopped out, and then we sold immediately. Sold into liquidity, it looks like, and then price reversed. So we had a revenge trade, and that isn't a sell setup. We didn't enter as per rules, so we got 2 problems here. So, of course, what are you doing? You're saying, cool, improvement topics. Only trade when the bias is strong. So that's one of the things we're going to improve on. We're going to put it down in our goal for the week. walk away for 10 minutes after any losing trade. Maybe that's your action. Every time you have a losing trade, you're like, cool, I get up, get out of here. I know that I'm a revenge trader. I need to put in place actions to fight that. Okay. And that's, again, there's many ways to do your review. Find a way that works for you. I know Cam, he says, don't kumbaya and put down your feelings and la, 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 la. You get laughed at prop firms. Yeah, you wouldn't. But review your trades and understand where your execution is and your performance of the execution, right? Let's continue. Here's some more performance considerations for your weekly review. The number of mistakes. How many mistakes did I make? Can I identify the main ones and set a goal to reduce them, right? Exit efficiency. What was the exits in logical areas? How much of a move did I take on average? Market environment. Are we in a high volatility or low volatility market? Should I adjust my approach around this? Should I widen my stop? Should I take profits faster? What happened in the last day or the last week? Right? Adaptability is the name of this game. You need to adapt to current market environments. This is why algos fail all the time. This is why strict approaches where it's purely mechanical often fail, because the market's constantly changing. As a trader, you need to adapt. Scalp versus hold. Would scalping be better in these market conditions? Or is it better to try and push my winners? What are my objectives? Right? My objectives are different to yours. Often I am holding the hell out of trades. I want to push them as far as possible. That is my style. Stop management. How often does stops get hit just for the trades to go in my direction after? Right? You look at everyone. Maybe my stops are too close on average. If I widen them another 20%, maybe I reduce the amount of losses by 50%. Interesting. These are what if questions you need to be asking yourselves, right? The next area, and again, I'll say this, you want to be like the devil reading the Bible. You want to see the details, the loopholes, all the things, right? So you want to dive into your statistics. Right? This is where you understand your performance, and this is how you can push your edge even further. So these are some of my statistics from one of my prop accounts. I've had 17 trades, 12 profitable, 5 losses. Cool. I'm running at 70.59% accuracy. That's great. But that doesn't mean I'm profitable. I need to pair that with my average win and my average loss. Let's have a look. Average profit is $41. Average loss is 18 with a 70% win rate. These are really good numbers, right? What's my biggest profit? $80. What's my biggest loss? 22. Is the biggest loss in line with my maximum stop level, right? My maximum risk? Or did I make a mistake? Or did I get slipped? Now I can look at these and say, cool, okay, well, let's say my performance isn't so good. Maybe my win rate is 50%, and my average profit is 1:1, and my average loss. I'm not making money. I'm break even with that scenario. Actually, I'm losing money because there's going to be trading costs involved. So now I know, cool, I'm not probably going to be able to increase my win rate unless I change my stop distance. So that may be one way to increase the performance, reduce your stop, increase the stop level, sorry, and that will change your accuracy slightly. Or the other way you could be saying is, cool, I need to reduce my losses by 20%. So I'm going back to $16, let's say, and I need to increase my profits 20%. And that would mean I'm going to $20. So on average, if I'm a 50% accuracy trader and I'm losing 16 and I'm making 20, that means my expectancy is around $4 per trade. So every trade I take over a large enough sample size, I'll make $4 and my account will grow, providing my trading costs are lower than that. So again, take the time to look at your statistics, look at your average profit, your average loss, your win rate, your biggest and your smallest loss, and get to understand what's happening and have a look at what can you do when you're reviewing your trades. Can I push these a little bigger? Can I take my losses a little bit quicker? And can I push my winners a little bit bigger? Or can I widen my stop to increase my win rate? Right? These are the factors you can play with. So going through my comments, is your biggest loss too big for risk management? How does your average loss versus average profit look? What are the number of trades for the week? That's a very interesting thing as well. Are you over trading? Right? What should you work on to increase the edge performance? And you're going to get this only from your statistics and reviewing your trades for the week. Oh, we've skipped forwards too far, I think. No, we haven't. There we go. Cool. So after you do all that reviewing on your weekend, you should be able to identify topics to reduce or stop, or red light topics, factors to be aware of, yellow light topics, and actions you need to continue doing or do more of, green light. I'll give a very, very quick example. Red light, I need to cut down on the amount of revenge trading. Last week I did 3. My goal is only to revenge trade once this coming week. If I can reduce it 2 times, I'm going to have a better performance. Maybe I made 5 mistakes in execution last week. Maybe my next goal is only to do 2. So I'm going to set that as my daily goal. I'm not going to take any mistakes in execution. Maybe my stop loss is too close. Great. I'm going to take that into my action plan. I'm going to increase my stop by 15% on average, or whatever it may be. Yellow light. Maybe I nearly got caught out with news. So I need to be more aware of news. So I'm checking news. Or I need to be more cautious on the bias change. When the bias is starting to reverse, you don't want to change your bias too quickly. It's like a slow moving train. It takes time to turn around. It takes time for all the participants to understand that, hey, we're going from risk off to risk on. And in the green light, maybe I'm doing things really well and I need to keep doing them. Like I'm constantly holding for 1.5 R, 1.5 times my risk winners. Great. Keep doing that. Maybe I can push it to 1.6. Check the correlations with the other Forex players. This has helped me out of keep me out of bad trades last week. So good. That's a good behavior. I want to keep doing it. So again, you're just setting up a plan to improve in the following week. And before your trading session, you are then reading through every single one of your improvement plans, right? Let's continue forwards. Okay, so what is the, okay, yeah, skipping forward. So we're at the question and answer period. So in the Telegram, we got lots and lots of questions and I'm going to try and go through them. And there's around about 20 that I'm going to go through. I'm sorry if I missed yours. I think I will have already covered it if I missed it, but let's go question one at a time. First question, what is the price action we see when we should exit an open position? Whew, this is a big one. This is a big one because it becomes a combination of personal goals and market environment and price efficiency versus inefficiency. And it's not easy. So let's talk about each of them. What is your personal goal? My personal goal is to hold trades longer. So I'm automatically pushing for more than 1R every trade. I don't want less than 1R. My goals are bigger than that. So I am automatically pushing just because of personal goal, right? Did price stall and do nothing? That's a good one. We are trading a momentum breakout trade. If price is stalling and going sideways, you're in the wrong trade, buddy. Get out. Is price moving against you? Okay, price moved against me. That's not confirming my breakout. Time to tighten my stop loss, right? When price is moving against you, as a behavior, tighten a little bit. I'm not talking like 50%. You can just reduce your stop by 10. Maybe the next bar it moves against you again. You reduce your stop by another 10%. Therefore, you're losing 0.8R instead of 1R. Perfect, right? IG bias. How strong is it? Did something change? I'm constantly, when I'm in a trade, I'm constantly checking the IG. I'm wanting to know, has everything just got messed up, right? Where is the next book or fix level? If we're trading towards a level, a book to be rebalanced, when it gets there, that's a good time to exit most probably. Or how did it respond to the book or fix level? Maybe it's going to smash all the way through. I don't know. No way to predict. Just watch, read it, and take a decision. Big bars and parabolic push exits. This is in the bottom right-hand corner. Like you can see it. That's a big bar. That happened so fast that it is inefficient. What happened is so many people got left behind. Effectively, price moved through all these levels, filled all these people. The participants can be confused, but everybody who's trying to sell got filled on the way down. There's less sellers. It's easier for price to move back up and fill that move because there's less sellers now. So exiting at the close of a big bar or a parabolic push is often a really, really good exit. I love that exit. Kaiser has been applying this one and likes it as well. But for me, if I get a sudden parabolic push or really, really big bar and I don't expect it, then I'm going, cool, I'm not holding anymore, I'm out. I close at the big bar. It's a nice way to take a profit. What happens when price tried to reverse? So this is what I'm talking about in this. Price tried to reverse, then it was bought back up. Tried to reverse, bought back up. 2 bars, bought back up. Cool. This is showing me it's not able to reverse. I'm going to hold. Maybe when I get 3 black bars, I will exit. Maybe I get 1 strong bar in reverse. And you can see, actually, you see the start of this. You've got a strong bar kind of pushing down there. That is a time to exit. Right? Is price suddenly rejecting something, throwing wicks? Hold up, let me get it. You're throwing wicks. Right? Throwing wicks is starting to say, hey, there's some resistance coming in. Price is moving up and getting beaten back down. Here also, right? You're getting wicks being thrown. So that starts to tell me, well, maybe I'm getting interested to exit my position or I might tighten my stop. Okay. How close to news or market open are we? If we're coming up to a market open, I will close positions because often those positions will reverse. So good question. Thank you. Let's go on to the next one. AAA setup. What is it? Could I write a checklist to confirm a AAA setup? First of all, the market does what the market does. All criteria are important. I can't say it any better than that because you might have the most perfect setup and it loses. You might have the shittiest setup and it wins. That's just the reality of the market. What we are trying to do is execute our edge over and over and over again. When that happens, we will slowly make money, right? Providing we've got good risk management and execution. But here's a bit of a checklist, and I think I've gone through this. For me, bias must be super strong and clear. Correlated pairs are matching the required inter-market behavior. So I would say, let's say the IG, let's say we're trading in the London session, the DAX is moving up strongly, it's super clear. Then I'm saying, cool, we're in risk on. Let's have a look at GU, right? Maybe I want to trade GU. Maybe its price action is really, really clean and nice. So then I look at EU, the correlated pairs. Is Euro USD moving up? Yes. Now this is starting to look good. Then I want to see a price action. Is it clean, not choppy, not sideways, single direction move, no pullbacks being reversed? This is really, really clean. I love this. Every time we have a pullback, it's bought back up, pullback, bought back up, right? There's not big wicks. It's not hugely volatile. It's quite a smooth move. This is super simple to trade. When you get entries, you're in profit very, very quickly in this. And there's no upcoming news or market open. So personally, I look for my criteria and I execute. We either have a trade or we don't. It's as simple as that. I don't really look at A-grade setups from the market or the correlation. I want to see all my criteria there. What I do look at is I look at afterwards, did I execute in an A-grade fashion? Right, and that's where you get real performance. Is if you get an AAA grade setup and you execute really badly, then it doesn't matter. You're just giving your edge away. But you need to work out how can you maximize your edge. Good question. Thank you. Let's have a look. Short-term confluences, what to see and what to avoid. Very quickly. So confluences. So make sure you're looking at the whole picture, not just part. I want to be understanding what the hell is driving price for my currency pairs. If I don't understand it, I don't trade. Simple as that. If I look at things and I'm going, I am confused, it is not making sense, I do not trade. So I must see. Intermarket must be clear risk on or risk off. Or the way I will say it is your definition of strong risk on or strong risk off. Currency pairs must be displaying a correlation in play, right? As I said before, let's say you're trading AU to a buy side on a risk on environment. EU should be going up. UCHF should be going down. UCAD should be going down, for example. Technical setup must be there and must be clean. The next book or fixed level is not super close. Enough room to trade. No news coming up. No market open coming up soon. Things to avoid. Correlated pairs not matching behavior. So for example, AUD USD in buy breakout and Euro pushing down. Euro USD pushing down. That's not the right behaviors. Warning sign, don't trade. Mismatch markets. Euro USD, Euro Swiss franc going in the same direction. That's not supposed to happen. Don't trade. Intermarket correlations are not being respected. For example, DAX is pushing up strong and the pound US dollar is pushing down. That shouldn't happen. These are very, very quick ideas. So again, I'm not looking at a chart so much. I'm looking at the correlations and what's happening and how the chart is then respecting those correlations or not respecting them. Cool, good question. Next one, 5 minute compared to a 1 minute setup. Now, first of all, I am not trading 1 minute. The reason why is I'm very comfortable on the 5 and I'm profitable on the 5. I don't need the 1 minute. So, excuse me. So that's not for me, but some of the guys are. Cam is, he loves a 1 minute. So, but overall, it's all about speed, baby, which means they're technically the same, but the 1 minute you're taking a faster movement, not faster in terms of price, but in time, right? If you can get your head around that. Price will move the same on M5 or M1. It is price. Price is price is price. Regardless of time frame, it is price. 1 minute will have a bigger drag caused by trading cost, right? Often you are trading a smaller move distance and a tighter stop loss, right? So if you get a smaller move out of it, then your costs have a bigger impact on the trade. 1 minute will have tighter stops and often smaller take profits. Cool. You will need to make decisions faster, right? 5 minute versus 1 minute, the price is the same. It's just data compression. You are not seeing what's happening in the M5 candle as much as what you're seeing the M1. It's more information, but that information can fake you out quicker. Noise versus signal, they call it. But personally, I think it's not needed. I think I'm okay just trading the 1 minute, and that's cool. If you want to trade it, have a go. See how you perform, right? See if you really, really like the 1 minute and you can trade it. You're going to get more entry signals. You get more pullbacks and entries. So if a bias is strong and everything else is lining up, then take a trade and go for it, you know? There's no right or wrong here. Just see what you're comfortable with. Good question. Thank you. Next one. Which are most influential, which biases or commodities are most influential on which pairs was the question. Commodities. So commodity pairs are the highest impacted. So the highest impact in terms of the currency pairs is US dollar CAD and AU USD. The reason why is the Australian economy is a huge mining economy, like we talked about before, and Canada is the 4th largest oil producer in the world. So both of them get beaten up and moved because of commodity. So for oil, hits CAD the hardest. Gold has a correlation with AUD. Now, it doesn't always exist. Correlations go in and out of favor. Sometimes the correlation is really strong, sometimes it's weak. Other things are affecting the market. Iron ore has correlation with Australian dollar. The trick is to just be aware and check. Correlations swing in and out of importance for a pair, right? So, for example, you might have a scenario where economic news has come out. That economic news may be driving the currency pair, and the participants may not be looking at referencing what is happening with the commodities, right? Good question. Thank you. Let's go to the next one. Having a losing day. When should I quit? Wow. When should you walk away? Hiya. Okay. Again, this one is personal, right? It's your money, your objective, your emotions, and your execution. The question is hard to answer as it ties really back to you. How strong is your personality? You know, if you're the kind of person that can take 5 losing trades in a row without even getting flustered and just can execute perfectly without revenge trading and it's not changing your behaviors, cool, live your dreams. The other thing is, you know, what if you're trading 0.01 lot on a $10,000 account? You can lose all day and you'll probably be only down $5, right? So the question is also tied to your risk management. How much money have you lost in a day? So to help guide you on that question, I would start by defining what is the maximum you ever want to lose in a day, right? You can say percentage or money. And then I would say 30% of that is a target to step away. So if I said I'm going to lose $1,000 in a day, cool. I cut myself out of 300. That would be a nice way to go. Therefore, I'm not taking my biggest losing day. I'm still okay. I can come back and trade the next day. The markets will still be there. It's no biggie. So additionally, I'd be very aware of how I'm feeling in a losing day and if it was impacting my performance. If you're trading bad because of it, it's time to shut off a PC. Like, you know, if you take one trade and you are just so triggered by the market that you can't think straight and you want to jump straight back in when there's no rules being applied and you catch yourself about to do that, time to shut off and walk away. Hope that helps. Good question. Thank you very much. Next one. Can I backtest without a sentiment? Well, first of all, the bias is the key. So yes, you can backtest without a sentiment, but it's not the whole picture. It's not what we're trading. We are trading effectively a correlation. So you only have part of the picture. You can backtest the technical setup for execution, right? You might want to test how good your execution is. That would make sense, right? Basically, it's like riding a bike without pedals. You can roll in the right direction, but you don't have full power. TradingView and Forex Tester, Forex Tester 5 with the data package, you can backtest these. Right, you can use them. You can actually pick up the different market data and data replay. I don't use TradingView. I don't know it, but I think we've got some really good people in the Telegram if you ask. Forward testing is 1000% better in my opinion. Market review and recording of trading sessions is also excellent. So for me, choose a window every day, 2 hours, where you are demo trading and just executing and get a sample size, which is significant. Get up to 100 trades. How is the performance? Get up to 200 trades. How is the performance? Again, there's no rush. The markets will always be there. Just make sure you validate what you're doing, right? Don't jump into this if you don't know if it has an edge. Don't jump into it and do that because you're going to execute different than everybody else. You're going to have different behaviors and different biases and different level of importance, and work it out. Get the experience with the approach. And like everything, like the karate master at the start says, doing the practice is what gets you better. Right? Okay, let's keep going. Good question. Thank you. Question, how do I prepare myself for pre-market? Again, this is a really key topic, and it's going to be a little different for everyone, but I'm going to talk a bit about me, what I do. First thing I do is I review my weekly plan, right? Every day before I trade my trading session, I look at my objectives and say, okay, this is what I learned from last week, and this is what I'm trying to achieve. So I'm making sure they're front and center in my mind to try and achieve them during the session. It makes me more intentional and more aware of where I want to focus. Right? Next thing I do is spend time on my book of horrors. What's the book of horrors, you say? Every time I screw up in a big way, I screenshot it and I save it in a PowerPoint. I got this technique from Tom Hogard. I really like him as a trader, and ultimately, I think this is one of the best techniques for stopping me doing those bad behaviors. And what I do every time I have a big mistake, a big error, a big behavioral problem, I over risk, I move my stops. I also put how much money I lose by doing that topic. And then I start to get aware that, hey, every time I do this, I lose money. That's dumb. Don't do it. So I read through it. I got it as a PowerPoint. I read through it before my trading just to remind myself of the damage I can do if I'm out of control. I check the upcoming news. One of the first things I do. What's going on? What's the session going to be like? Do we have many news announcements or are we free? Then I check the intermarket and I understand if the Forex pairs are respecting, right? I talked about this many times. Check the intermarket, check the IG, what are the indices doing? Are they strong risk on? Are they strong risk off? If they are the Forex pairs respecting that risk on or risk off? I make sure I don't have interruptions, wife, kid, dog, or other. I lock the door. My family knows I'm trading now. So I don't want any interruptions because I tell you what, the worst trades in the world are when your kid's like, hey, come outside and play for 5 minutes. You got a position on, you go outside and play for 5 minutes, you come back, you got a huge loss. Oops. I make sure I'm not in a truly shitty mood or other impacting mood. I don't trade angry. I don't trade when I'm not sharp, if I'm tired. I trade when I am really, really in a good place to trade. So that's my preparation. That's very quick. I hope that helps you and I hope that answers your question. Good question. Thank you very much. Let's go on to the next one. Gaps. What are they and why? Now let's start by having a look at this price chart to the left. You can see that price closed here and then it reopened all the way down there. That's a gap. Right? Price did not deal in this area. It came back up and it left now this area undealt. Now, if you remember what Cam always says, is there's no orders left open in the market. If there's orders dealing in that area, we can expect price to come back to that area at some point. So basically what it is prices opened and closed or closed and then opened in completely different price levels, not next to each other. Can be caused by market open, can be caused by news, can be caused by rollover or super fast momentum. Sometimes gaps appear. Effectively, it represents a price range where no one could deal. There will be orders needing to be filled in that area. The reason why we say very important is we can predict price will try and fill the gap, but we do not know when. It may be in the next 30 minutes, or it could be in 2 days or 2 weeks. We don't know. It's just something to be aware of and potentially an area where price is going. That's all. So we will be just looking at it and saying, okay, well, are there gaps in these markets and could we be trying to fill those gaps, right? And if let's say you're here, you're saying, cool, we've got a gap in the market. I got a risk on environment. You might be taking an entry here because we're going to go through here and you might be taking your exit right away through the gap, right? It's legitimate. Good question. Let's go next one. Fixes impact on daily bias. So the fixes shouldn't impact your bias. You should be getting your bias from your IG. The fix is just a place where price will move towards at some point. The goal is to be aware of these areas as they represent a price level where a large volume of dealing has been done. Like books, we do not know how price will react when they get there, but we are aware they could cause a reaction. If you are entering a buy trade in a fix above and close above, it could cause your trade to fail. So let's say that's supposed to be close, not close, but basically if the fix is too close to your entry, it could cause a trade to fail. If you're in a winning buy trade and the fix is above, it's potentially a good exit point. So that's how we use the fixes. Good question. Next one. How to start money and expectations. First of all, don't rush. If you're a new trader, you're going to make all mistakes. You're going to have behavioral issues, psychological issues, and execution issues because you haven't worked through them yet. And everybody's got it. Everybody is driven by fear and greed. Everybody gets fear. They miss out on trades because of it. They don't exit trades because of it. They get greedy. They push trades when they shouldn't be, so on and so forth. If you're new, don't rush. Right? But I would advise the following for a new trader. Start with a small account, $100 or a cents account. Trade for excellence in execution. Don't trade for profits. Process over outcome, right? Trade for getting your process super strong. Your goal will be to nail the process every time. Money can come later, but if you never get to a stage where you nail the process, you will have an issue. Size up from there. Don't go from small to large. Increase as it makes sense. Again, it's personal. So, like if you start a $100 account and you trade well for a month, dump 1,000 in. See how you go. Right? You trade your 1,000 well, and your process is great. Dump another 1,000 in. Risk management comes back to you and your goals. Personally, I run 0.25% on trade, but I will reduce it during bad performance or in tricky markets, right? So I won't generally go bigger than 0.25 per trade, but that's how I manage risk, and this is part of your money and expectation. When to ramp up and push. Let your performance dictate that. If you're trading shit, stay small. If you do good this week, increase it a little, right? Again, come back to don't rush. Get the process right. Get your improvement plan every week. Review your trades. Get better every week. The more you get better, the better your performance will be. That's all I can say. Okay. I hope that answers your question. Thank you. Next trade, spreads. Next question is spreads or commission broker. Check. Trading costs hurt your performance two ways. Through account drag, you have to overcome it with performance. The other is poor execution, slipped orders, or bid ask. Could be very wide. Check the brokers. MyFX Book, you can Google MyFX Book broker spreads, and you can compare the broker spread and commissions on average, right? You can work out if your broker's bad or good. At Propsense, we use Go Markets. We have a special deal set up. There is a referral. The deal is not to do with trading costs so much. We get it, but we get better execution and price feeds. So is what Cam has told me on that. So really, and I'm trading on Go Markets. I've had a payout from Go Markets. I've withdrawn funds from there. They paid me in 24 hours, very fast, which is fine. That's great to me. And the biggest thing was the price execution is really sharp. We really don't get slipped, and I really like how fast that broker is. It's super good. So check him out. But again, do your homework. I'm sorry, there's so many brokers, so many different cost structures for using a broker. You need to check it and work out what's the best for you. Good question. Thank you. Next question. How much time to allocate? I would say sustainable time. Again, up to you, right? Trading needs mental sharpness and awareness of your state. If you're tired, angry, hungry, etc., it'll impact your performance. And that impacts it in the way of poor execution, decision making, and willpower. Personally, I'd aim at 2 to 3 hours per session, maybe 4 hours per session. You want to have a life also, but then again, monitor yourself. If you're trading after doing a full day's work, 6 hours at the chart probably isn't a good idea also. So again, it really comes back to you. How do you feel? What is your performance? What are you available to focus and give full attention? I hope that answers your question. Again, it's very personal. How the news influences the market beforehand and after release. So first of all, caution. I don't trade the news. I don't trade near the news, but I will trade after the news when price has normalized. But standard behavior before the news is that the market goes sideways, and often institutional traders get directionally neutral. They do not want to get hurt if they are in a directionally biased position, right? They have risk, so they get directionally neutral. The news events represents a change in liquidity environment, as new information could surprise the market. The direction could completely shift, right? For retail traders, next available price dealing is what makes orders slipped and executed poorly. This makes the news super dangerous. Additionally, the market often clear the books, which means price often spikes up and down in a large range, which takes all the stop orders and all the limit orders into the market. And this is one part of what makes news super dangerous. It hurts both anybody in the market on the buy or the sell side. After news, if a directional bias is clear and matches the intermarket bias, these conditions can be really excellent. So 20, 30 minutes after news, that's when I trade. Beforehand, to give a bit of a picture of what happens before news, let's say this is news announcement, you might have a price coming up to it, and then it might suddenly do this, right? Hits your news announcement. Let's say we're going to clear the books. Straight up, 1 second, straight down 1 second, and then we come back and we might choose our direction afterwards, right? News is really freaking dangerous. Don't trade it. Stay away from it. Don't trade before it. Don't hold trades into it. Just chill out. Let the markets do their job. The news will come. Wait until it's calmed down, then trade. Hope that makes sense. Basically, news is risk. It's additional risk that you don't need to take. Okay, let's continue. Good question. Thank you. What do you want to see to pull the trigger? Look, I'm sure I've covered it, but the devil is in the details, guys. Strong IG bias, risk on or risk off. Currency pairs following the bias. Confluence with the currency pairs, right? No news anytime soon. No market item. Nice momentum in the direction of bias. No trapped ranges. Clean price action. No crazy risks or choppiness. Quick pullback before the breakout. That's what I want to see. I know I've gone through it. Again, don't think in terms of AAA grade setups will avoid losses. It doesn't work like that. If you get away from D grade setups, yeah, sure, you're going to avoid losses. But AAA grade setups will lose as well as win, right? They're just the best conditions for you to milk that edge, right? When these factors are missing, I don't want to trade because I don't know what's going to happen. Whereas when I have all these parameters in place, I have a good probability that I know the outcome of the next breakout. And that's it. Good question. Thank you. Next question. What do you not want to see to abort a trade idea? I'm sure I've covered it again, but the devil's in the details. Price isn't respecting the IG market movements, right? Let's say we are in a risk on scenario and EUR USD is going down. I don't want to trade it. I'm confused. I don't know what's going on. Terrible price action. Choppy, random, barcode, sideways, horrible, however you define it. Shitty market conditions. I don't want to trade. It's dangerous. Dead momentum, sideways, right? We're trading a momentum breakout effectively. If there's no momentum, there's no trade. Correlated markets also not supporting the idea. So I'm trading AU to the upside. I'm buying AU. EU is not breaking out upside. That's a warning sign. Right? Maybe EU is going down. Oh, I'm scared. I don't want to trade. News coming up on market open soon. Again, it represents a change in liquidity, could represent a change in direction. Book or target too close. Pretty standard stuff I've talked about a lot. So I hope that answers your question. Thank you for asking. Next question. What would you train your eyes to see if you had to teach yourself again from scratch? I told a story at the start about the karate practitioner. That's it. There's too many areas to get lost in trading. This approach is actually really easy. We're trading a bias with a confluence, with a breakout on momentum. Focus on that. That's all. Don't look at anything else. Execute, review. Execute, review. Right? Be adaptive to the conditions. So I would focus on the bias first. Work out your meaning of strong risk on and strong risk off, and how do you check when it's being respected? Focus on the confluence of the pairs. Watch what happens when EUR USD, Euro USD breaks out to the upside, and US dollar Swiss franc. What should that do? Does it break down? Does it break down straight away? Does it hold back? If it holds back, what happens after? Right? Start to get a feeling of the confluences, how they behave. They may shift over time, slightly, but just focus on that. Focus on how price moves in the trade, right? Once you get in, we're taking the same trade every time. Same trade every time. Bias with confluences, with a breakout on momentum. Same trade every time. So what happens after you get in a trade? Profile good behaviors, right? When the price is moving really, really good. Profile when you should exit. Focus on the feedback loop. Review weekly and improve on your plans. Do your improvements every week. Look at your improvement plans and improve. Ignore everything else and just work like hell. That's what I'd do, right? Knowing what I know now and trading how I trade now, that's exactly what I do. I would just spend so much time on execution, review of execution, execution, review of execution, and just keep going through it. Really, the information in here and the other videos, you don't need to learn it any deeper. This is a game of execution and improvement of execution, right? Okay, let's continue. Good question. Thank you very much. Key differences in reading a chart compared to support and resistance, supply and demand, or reversal trading. Okay, let's look at a chart on the left-hand side. I've pre-marked this. You've got key support level here, resistance level there. You've got a support level here. Support and resistance trader is waiting for price to come down, and they're taking a buy, taking a sell, right? They're effectively trading the reaction to those key levels. Supply and demand, you've got rally, base, drop. This is now a supply area, drop, base, drop. We've got a supply area, drop, base, rally. We've got a demand area. Price comes back to the demand area, then goes up. Price comes to the supply area. It responds, but doesn't so much. Comes to the supply area, goes down. Effectively, reversal can be continuation techniques depending on the methodology is different. I would say there's no right and wrong. I mean, I traded supply and demand for many years. I've done Malaysian support and resistance, and I've done normal support and resistance over many years. The big difference is this. We don't care about, well, hold on. We don't care about so much what's over here. We care about what's happening right now, and we care about how the bias is affecting what's happening right now. Okay, sure, if price is coming back into here, you could say, I'll take a target there. I'm going to take my sell. Let's say we have a pullback and a breakdown. I'm going to take my entry here, and I'm going to play it down there. That's cool. You can use that. That's no problem. Again, it comes back to you. It's your money. But ultimately, it's different. We are not trying to reverse the market. We're taking a continuation trade, a momentum trade on the back of a bias with a correlation. We are not trading when price is coming to a book and the bounce off the book, or price is coming to a fix and a bounce off a fix. So I hope that answers your question. It's different. Get your mind away from those things. Get your mind to current market price environment, and the bias. And I think you'll get this style very, very well. So great question. Thank you. Let's go to the next one. What markets should I reference for my bias? Where should I look? The goal is to understand what is a moving price. That's really what it is. And I've got here too many screens because it can be overwhelming. And you said, I remember you said you've got one laptop. You have the IG on one window and your MT4 on 1 minute window, and just flick back between them. Like, you can check the IG markets every 20 minutes or 15 minutes. It's like a slow moving train. It doesn't crazy change. And even if it does change, I'm not getting in a position until it's really confirmed it's strong risk on or strong risk off. So quick example, you don't need to look at every single indice market. If you are trading London, first of all, start with the DAX. It's the biggest European economy. Start there, check out what the FTSE is doing. And then if you can see the DAX and FTSE are strong risk on, and then you can see the currency pairs moving in the correct behavior, check the S&P 500 for the representation of US dollar. You can use those three if you really want, and you can formulate your bias from that. That's fine. Right? I like to hunt for the reason. You won't get all the reasons. You're not looking at commodities. You're not looking at oil. In that scenario, you might be wanting to trade the most highest moving pairs. So Euro USD, Swiss franc, GU, these pairs would move very well in the London session, and you'll have a good time. So again, work your process, get a feeling for it. You're not going to be exactly the same as everybody, but ultimately, we are a bias trader, so you need to know the biases. In the London session, do you need to know? Actually, even better, New York session, do you need to know what the ASX is doing? No. Who cares? Get to know what the biggest markets are doing for that time segment that you're trading. So again, if I want to work out what's happening, I hunt. I hunt along all the indices and the commodities. I try and work through what's happening, and that's part of my my plan. Good question. Thank you very much. And ladies and gentlemen, I'd like to thank you again for all your questions. I know there's some I've missed, and I apologize. I think I already covered them. If I didn't, just hit me up and I can answer later. We've been going for 2 hours, so it's a pretty long session, and it's 2 o'clock in the morning for me. So this is pushing it because I've got young kids and I've got to get up pretty early in the morning. So come back to me with any questions. You know who I am, and you can hit me up in the Telegram or on the Discord. I don't check the Discord direct messages too often, but the best is if you ask a question, ask it in the Telegram or Discord main chat, and then everybody can see the answer. So trade safe, may the pips be with you, and have a great day ahead. Thank you very much.